aboard Nilesh Shah, MD at Kotak AMC, and find out what he's making of the market right now. Nilesh, hi, good morning. Good to have you on the show as always. Nilesh, I guess it's now over to Trump, Putin, the US delegation, which is going to visit India month end, and then eventually, of course, the meeting between Prime Minister Modi and Putin as well later in the year.
Lots of events, Aisha, and markets will move in line with the events. But as things stand today, at 50% tariff, it's trade embargo. Our companies in sectors like textiles, chemicals, auto components, aquaculture will have to find markets other than American markets. And I just hope and pray that India leverages its own trade position. After America, the second largest goods deficit in the world is done by India. We have more than $250 billion plus trade deficit. By giving access to our domestic market, we should seek opening up of local markets for Indian products. And we must support companies in this sector so that they can survive this 50% tariff imposition. At the same time, all the event which you mentioned obviously shows that government is trying to work around it. Let's hope for the best, but prepare for the worst.
Yeah, he is hoping against hope right now. But Nilesh, how do you prepare for the worst? And what could that worst be? Because like you said, for now, we're already grappling with that 50% tariff. And, clearly a lot of concerns around exporters, textile, leather goods, etc., etc. From a market standpoint, what could the worst be? Because here's an index alone, which is now into a sixth consecutive week of decline. We've had a rough patch with the FI selling India all through the month of July, and it hasn't got any better. In fact, on the index alone, we've seen a 5% decline.
Aisha, as Peshwa Bajirao mentioned, strike at the root of the tree and branches will fall. Let's focus on economy. Markets will take care of itself. FPIs also will be taken care by focusing on economy. In economy, we have to ensure that we leverage the second largest trade deficit in the world of more than $250 billion plus to ensure that we can divert our exports from goods where America is levying tariff to other countries. And when you run $250 billion plus deficit, it should be possible. Second, we are also one of the largest spender of travel and education. 1.7 million Indians traveled to America. 2.6 crore people traveled abroad. We need to leverage our spending on travel, on education, on goods deficit, on giving access to American companies in Indian market for opening up markets for our exports. The second, obviously, is to stimulate our domestic economy. The government has taken steps through income tax cuts. There is potential GST rationalization as well as petrol diesel price cut probably on the anvil. There is 8th pay commission, and there is also reduction in interest rate. Now we must accelerate ease of doing business so that domestic economy is stimulated. And yesterday, as Prime Minister mentioned in Bangalore, we must focus on creating independence in technology. Today, we are dependent on the world for R&D and innovation. We must ensure that we become Atmanirbhar in R&D and in technology. It's not going to happen in a hurry, but we must have a roadmap. If we take care of economy, which is the root cause of everything, then markets and FPIs will be taken care on its own.
Good morning, Mr. Shah. This is Shrishti also joining in. But in the long run, Mr. Shah, it will only be earnings that is expected to drive the stock performance to be backed by the growth of the economy and maybe outperforming that. As we are at the back end of the earnings, if you can help us analyze that, which are some of the sectors where you believe that the outperformance continues or likely they are expected to outperform the rest of the sectors, your sector bets as of now?
So, Srishti, while Conventional wisdom do suggest that stocks are slave of earning power. But do remember that returns are also based on valuation. You could see 100% earnings growth and valuation derating, generating no return. So we must ensure that not only our earnings grow, but our premium valuation, which is one of the highest in emerging market, continues to sustain. If earnings grow and valuation get derated, then there will be no return for investors. At this point of time, the June 25 quarterly results is more or less in line with the expectation. Of course, from double-digit earnings growth, it has come down to high single-digit. But 7-8% earnings growth is not bad. Within overall earnings growth for the market, there are sectors which have done well. There are sectors which have disappointed. But FY26 is year of consolidation. We should be looking at earnings of Nifty EPS somewhere around 1100 to 1125 rupees. Can the second half, thanks to monsoon and consumption boost, revive? As of today, we haven't heard that in commentary from corporates, but who knows, festival season can bring the cheer. The focus will be on FY27 earnings. Can that move into double digit? And a lot will depend upon how the situation evolves.
Yeah, too many things up in the air and too many moving parts there. But Nilesh, let's talk about what we have clear visibility on. We don't know what's going to come about from the tariff talks and all the diplomatic conversations between India, Russia and the US and thereafter. But when you talk about earnings, where do you think the fillip, like you said, we've got an early onset of festive season this time, so perhaps that fillip is anticipated. But then again, it's not really going to have such a large multiplier effect. Don't you think it's going to be restricted perhaps to just staples, autos, etc.?
So, Aisha, clearly we need velocity. The government spending is at all-time high and fiscal profligacy has given way to fiscal prudence. We are one of the few countries in the world where debt to GDP ratio has come down between subprime crisis to COVID crisis. On the monetary side, we have taken steps on the liquidity as well as the rate cut. Both fiscal and monetary put together is not resulting into acceleration in growth. It's one of the highest in the world, but it is well below our potential. The weak spot in this whole thing is private investment. There are multiple reasons why private investment is not on the front foot. One could be that large companies are doing investment, but small companies are not. In many cases, technological disruption is unnerving entrepreneurs to commit capital. In some cases, there is succession issue. The new generation doesn't want to do old economy business. So we'll have to ensure that ease of doing investment is accelerated. We have taken many steps, but we have a long way to go. This 1 lakh crore R&D fund, which government has announced, is a step in the right direction. If we can leverage that appropriately, then who knows, the private sector investment will also pick up. So while government and consumption side steps have been taken, we need to revive private investment.
Yeah, absolutely. And, going by the commentary from some of the players, at least this earnings season, at least L&T, it seems like it could be on the annual, or at least, green shoots seem to be emerging. But Nilesh, as an investor, like you said, FY26 pretty much all is in the price, a lot of question marks still. But how is it that you prep yourself for FY27? Because the market is a forward-looking beast that's going to start penciling in and pricing in FY27 about 3 to 6 months earlier itself.
So, Aisha, in this kind of environment where events are fast-paced, unpredictable, it's always back to the basics. There's no way we will be able to predict what President Trump is thinking, what kind of tariff actions will happen. So it is time to focus on basics, find out companies which are relatively immune from global headwinds, find out companies where valuations are reasonable and management is committed to governance and growth. Today, fortunately in India, there is a large amount of IPO pipeline. There are many entrepreneurs from second and third tier towns and cities coming into the market. It's almost similar to, Indian cricket team. There was a time when Indian cricket team was dominated by metros. Mumbai, Shivaji Park, contributed probably half of the team. Over a period of time, we have seen tier 2 and tier 3 towns and cities cricketers coming and making an impact. The same thing is happening in Indian entrepreneurship. There was a time when large business houses dominated the narrative. Now we are seeing entrepreneurs coming from second and third tier town. So it's back to basics, ignore the noise, focus on long term. And obviously you'll have to take 1 or 2 hits in this process. It's unavoidable.
Hi, morning. This is Snehi also joining in. You were just giving that cricket analogy, and in that parlance, where in the market are you seeing some market is not, paying a lot of attention to right. Market is not, paying a lot of attention to right now, relatively sheltered from the tariffs. Anything that could prove to be a safety net to investors right now?
So we are under no delusion that we are so smart that we'll be able to pick up something which market has not noticed. Market is much, much smarter than all of us. Market always teaches us, and that's why on my X handle, I say student of the market. I have to constantly remind myself that market is much, much smarter than us. As a Kotak mutual fund, we believe the domestic consumer discretionary story is something which will get supported by tax rate cuts, EMI burden reduction, potential GST rationalization or petrol diesel price cuts, and finally 8th pay commission coming into play. This will be across hotels, tourism, airline, home improvement, and all those kind of sectors, which is more domestic driven. Some of this money will also be saved and not spent, and hence financial services is something which one can look upon. Clearly, we are more focused on domestic stories than global stories. We are more focused on bottom-up stock ideas and betting entrepreneurs. In many sectors, the growth will still be good, though the valuation could be a challenge.
We let you go on that note, Nilesh. Seems like that's your call.
Yes.
The homeboy needs attention. Thanks for your time.
Thank you.
Okay, let's just revisit what the market has settled in at right now. It seemed like a quiet start, and from there we're still quiet. Look at what's happening within the EMS and the